Jesse Livermore, the psychology behind his biggest wins and losses. Part 1. The mind that could make millions. Before Jesse Livermore became one of Wall Street's most famous speculators, he had already discovered something that most traders take years to understand. The market isn't simply a battle between buyers and sellers. It's a battle between human beings and their emotions, fear, greed, hope, pride, impatience, regret, and sometimes overconfidence. Livermore experienced all of them. And that's what makes his story so valuable. Because he wasn't some emotionless trading machine who won every time. He was human. He made extraordinary amounts of money. He also lost extraordinary amounts of money. And behind those dramatic swings was something even more interesting than his trading strategy. His psychology. When Livermore was winning, confidence could become incredibly powerful. Imagine watching a position move exactly as you expected. You enter, the market moves in your direction. Your account grows, then it happens again, and again. Suddenly, you begin believing that you figured the market out. You start seeing patterns everywhere. Your decisions become faster. Your conviction becomes stronger. And that's where something dangerous can happen. You stop asking, what does the market tell me? And start thinking, I know what the market is going to do. Those two mindsets sound similar. They aren't. The first is observation. The second is prediction, and prediction can feed the ego. Livermore's greatest strength was his ability to recognize opportunities. But one of his greatest weaknesses was also deeply psychological, knowing when confidence had gone too far. This is something modern traders need to understand. A winning streak doesn't prove that you're invincible. It may simply mean that your strategy is currently aligned with market conditions. The market can change. Volatility can change. Your assumptions can become outdated. And suddenly, the same confidence that helped you execute good trades can become the reason you ignore warning signs. Think about a trader who turns $1,000 into $1,500. They're excited. Then $1,500 becomes $2,200. Now they feel different. They begin increasing their position size. Why? Because they've become more confident. Then $2,200 becomes $3,000. Now they feel almost unstoppable. But the market doesn't know their previous results. It doesn't care that they just made $2,000. The next trade is still uncertain. Yet psychologically, the trader doesn't see it that way. They see themselves as someone who wins. That's when risk can quietly increase. Livermore's story teaches us an uncomfortable truth. Your biggest danger may appear when you're doing well. When you're losing, you know you're in danger. When you're winning, you may not recognize it. That's why psychological discipline isn't only about controlling fear. It's also about controlling confidence. You need enough confidence to execute your plan. But not so much confidence that you stop respecting uncertainty. And this brings us to one of the deepest questions in trading. How do you know whether your confidence comes from experience or from ego? Experience says, I've seen this setup before. I know the risks. I'll follow my rules. Ego says, I'm right. The market has to do what I expect. Experience respects uncertainty. Ego hates uncertainty. Experience manages risk. Ego increases risk. Experience can accept being wrong. Ego takes being wrong personally. And that distinction can determine whether a trader survives. Jesse Livermore's life gives us a powerful warning. You can understand markets. You can develop excellent analytical skills. You can make enormous profits. And still lose everything if you fail to understand your own mind. That's what we're going to explore throughout this video. Not just how Livermore traded, but why he sometimes made the decisions he did. Because if you understand that, you're not simply learning about Jesse Livermore. You're learning about yourself. Part 2. When confidence becomes dangerous. There is a moment in every trader's journey when confidence begins to feel like certainty. At first, confidence is useful. You study the market. You practice your strategy. You take losses. You learn from them. Eventually, you begin recognizing patterns. Your execution improves. You start making better decisions. And then, you have a winning streak. One trade works, then another, then another. Your confidence rises, but something else may be rising with it, your ego. And that's where things can become dangerous. Confidence versus overconfidence. There is an important difference between saying, I have confidence in my setup, and saying, I know what's going to happen. The first statement is reasonable, the second is dangerous. Because no matter how experienced you become, you never control the market. You can analyze the trend, you can study price action, you can understand market structure, you can identify probabilities. But you cannot guarantee the next candle. You cannot guarantee the next hour. You cannot guarantee the next trade. The market always has the final word. The winning streak trap. Imagine you take 5 trades. You win all 5. Your account is growing. You feel calm, you feel sharp. You start thinking, maybe I've finally figured this out. Then you see another setup. Normally, you would risk 1%. But this time you think, this one looks extremely obvious. So you risk 3%, maybe even 5%. Why? Because confidence has changed the way you perceive risk. The trade doesn't actually have a higher probability simply because your last 5 trades won, but psychologically, it feels safer. That's the trap. The market doesn't remember your wins. The market doesn't know that you won yesterday. It doesn't know that you made $200 this morning. It doesn't know that you've had 10 winning trades in a row. Every new position begins with uncertainty. Your previous results don't give the next trade permission to succeed. This is one of the hardest lessons for a trader to accept. Past success doesn't remove future risk. Livermore's psychological battle. Livermore experienced enormous success during his career, but his story also demonstrates how difficult it can be to maintain discipline after becoming successful. When a trader becomes highly confident in their own ability, they can begin trusting their judgment more than their process. That's dangerous. Because your process should protect you from your emotions. If you abandon your process whenever you feel extremely confident, then your process isn't really controlling your trading, your emotions are. The ego doesn't like being wrong. Here's another problem. A trader makes a prediction, the market moves against them. Instead of accepting that their analysis was wrong, they start defending the position. It will come back. Then, I'll give it a little more room. Then, the market is just manipulating the price. Then, I'll add another position. Notice what's happening. The trader is no longer managing a trade. They're defending an opinion. And those are two completely different things. Your position is not your identity. This is a powerful psychological distinction. You are not your trade. If you buy USD and it falls, that doesn't mean you are stupid. It means the position isn't working. If you sell gold and gold rises, that doesn't mean you're a failure. It means your current market idea was wrong. Professionals can separate themselves from their positions. Amateurs often don't. They become emotionally attached to being right. And once being right becomes more important than protecting capital, everything changes. The dangerous sentence. One of the most dangerous sentences a trader can say is, I know this trade will work. Replace it with, I believe this setup has an edge, but I could still be wrong. That small change creates a completely different mindset. You can have conviction. Without pretending you have certainty, you can take a trade. While accepting the possibility of losing, you can be confident without becoming careless. That's mature trading psychology. Confidence should change your execution, not your risk. If your skills improve, your execution should improve. But that doesn't automatically mean you should dramatically increase your risk. A trader who becomes more experienced should ideally become more selective, not more reckless. They should understand when to participate and when to stay out. They should know their limits. They should recognize when emotions are influencing decisions. And most importantly, they should remain humble enough to say, I don't know. That sentence is incredibly powerful in trading. Because the moment you accept that you don't know what the market will do next, you stop trying to control something you cannot control. The real test of confidence. Here's a test you can use in your own trading. After a big winning trade, ask yourself, would I take the exact same trade with the exact same risk if I had just lost my previous trade? If the answer is no, your emotions may be influencing your decision. Then ask, would I take this trade if nobody knew about it? That question exposes ego. Sometimes traders take bigger risks because they want to prove something to themselves, to friends, to other traders online. But the market doesn't reward you for looking impressive. It rewards disciplined decisions. Humility is a trading skill. The best traders aren't necessarily the people who think they are always right. They're the people who remain open to being wrong. They can change their mind, they can exit, they can wait. They can admit, my analysis was wrong, and move forward. That's not weakness, that's strength, because the market will eventually humble every trader who believes they are bigger than it. Confidence can help you execute, but overconfidence can destroy your discipline. So don't try to eliminate confidence, control it, believe in your process. But respect uncertainty, trust your analysis. But prepare for it to fail, take your setup. But protect yourself if you're wrong, and never confuse a winning streak with proof that you have mastered the market. Because the market has a very simple way of teaching humility. It waits, and eventually, it gives you a trade that doesn't behave the way you expected. The question isn't whether that trade will come. It will. The question is, what will you do when it does? And in the next part, we'll look at another psychological battle that can completely change a trader's behavior. What happens inside your mind when you're on a winning streak and why success itself can become a dangerous trigger. Part 3. The psychology of a winning streak. A winning streak feels like proof. Proof that your strategy works. Proof that your analysis is improving. Proof that you're finally becoming the trader you always wanted to be. But there's a hidden danger inside a winning streak. It can change the way you think. And sometimes, the biggest threat to your account doesn't appear after a loss. It appears after a series of wins. Imagine starting with a $500 account. You risk $5 on a trade. You win. Then you take another trade. You win again. Another setup appears. You win again. Now your account is growing. You feel calm. You feel confident. You feel in control. Then something subtle happens. You stop seeing each trade as an individual probability. Instead, you begin seeing the market through the lens of your recent success. You start thinking, I'm reading the market perfectly. And that's when the psychology begins to change. The illusion of being in control. A trader can have 10 winning trades without suddenly becoming 10 times smarter. Sometimes the market conditions simply fit their strategy. Perhaps the market is trending strongly, perhaps volatility is favorable, perhaps their setup is working particularly well in those conditions. But the trader may interpret the results differently. They think, I figured it out. This is called an illusion of control. You begin believing that your decisions have more certainty than they actually do. And that belief can lead to larger positions, more trades, looser rules, and eventually, a completely different trading system. The first big mistake. After a winning streak, many traders increase their position size. Not because their trading plan says to, because they feel safer. A trader who normally risks 1% might suddenly risk 2%, then 3%. Maybe they start trading larger lots because, I'm playing with profits now. But here's the problem. Profit is still your money. It doesn't become casino money just because you earned it from the market. If you make $300, that $300 belongs to your account. If you lose it, your account doesn't care whether it came from previous profits or your original deposit. Money has no emotional category. $300 is $300. The house money effect. This is one of the most dangerous psychological ideas in trading. A trader deposits $1,000. They grow it to $1,500. Now they think, the original $1,000 is safe. I'm only risking the extra $500, so they become more aggressive. But they're forgetting something. The $500 is real capital. It can disappear just as quickly as the original money. This mindset can make traders take risks they would never take with their initial deposit. And Livermore's story gives us a powerful example of how quickly enormous gains can become enormous losses when risk and psychology get out of balance. Winning can make you break your own rules. Think about your trading rules. Maybe you normally say, I only take a plus setups. But after several wins, you see a mediocre setup. Normally you'd ignore it. But now you're thinking, I've been reading the market well lately. So you enter. The setup wasn't actually good. Your confidence simply made it look better. Then another opportunity appears, and another. Soon you're taking 5 trades where you normally take 1. That's how overtrading begins, not necessarily from greed. Sometimes it begins with confidence. The strange thing about winning, here's something most new traders don't realize: winning can actually make you less disciplined. Losses remind you that the market is dangerous. Wins can make you forget. After a loss, you're cautious. After 5 wins, you may feel invincible. That's why professional trading isn't simply about learning how to make money. It's about learning how to behave when money starts coming in. Jesse Livermore's bigger lesson. Livermore's career wasn't a simple story of, he found the perfect strategy and became rich. His life was much more complicated. He experienced enormous success and devastating setbacks. That contrast is important, because it demonstrates that making money and keeping money are different skills. A trader might know how to identify opportunities, but that doesn't automatically mean they know how to protect accumulated wealth. The second skill requires restraint. When success becomes an identity, there's another psychological trap. You begin identifying yourself as a successful trader. At first, that's motivating, but imagine what happens when the next trade loses. Suddenly, the loss doesn't feel like just a financial loss. It feels like an attack on your identity. You think, successful traders don't make mistakes, so instead of accepting the loss, you fight it, you increase the position, you refuse to exit. You search for reasons why you're still right. Now your ego is sitting inside the trade. And once ego enters, decision-making becomes much harder. A professional thinks differently. A professional doesn't ask, how can I make this trade profitable? They ask, what is the best decision from this point forward? Those questions sound similar. They're not. The first question creates attachment. The second creates objectivity. If the trade is wrong, exit. If the setup is no longer valid, walk away. If the market isn't offering an opportunity, do nothing. That's discipline. The power of resetting. One of the best habits a trader can develop is the ability to mentally reset after a winning streak. Imagine you've just won 5 trades. Before taking the 6th, forget the previous 5. Look at the market as if you're starting fresh. Ask, is this setup valid? Does it fit my strategy? Where is my invalidation point? How much am I risking? Would I take this trade if my last 5 trades had never happened? If the answer is yes, fine, take it. If the answer is no, stay out. Your previous results should not decide your next trade. The goal isn't to feel invincible. A dangerous trader thinks, I can't lose. A disciplined trader thinks, I can lose, and I'll still be okay. That difference is enormous. The first mindset needs to be right. The second mindset is prepared to be wrong. And preparation for being wrong is one of the foundations of professional risk management. The real lesson from Livermore. Jesse Livermore's story isn't valuable because he always won. It's valuable because his life shows both sides of speculation, extraordinary success and extraordinary failure. And that teaches us something that a simple strategy tutorial never can. Your biggest challenge isn't always finding the right entry. Sometimes it's controlling yourself after the right entry works. Can you take a profit without becoming reckless? Can you have confidence without becoming arrogant? Can you grow an account without dramatically increasing your risk? Can you win without believing you've become unbeatable? That's the real psychological test. So remember this, a winning streak is not permission to abandon your rules. It's a reason to follow them even more carefully. Because when you're losing, discipline feels necessary. When you're winning, discipline becomes a choice. And that's when you discover whether you truly have it. Part 4, when you know the rule, but break it anyway. One of the most uncomfortable truths about trading is this: knowing what to do and actually doing it are two completely different skills. You can know that you should cut a losing trade. You can know that you shouldn't overtrade. You can know that you shouldn't revenge trade. You can know exactly how much you should risk. And yet, when real money is on the line, knowing isn't always enough. This is one of the most important lessons we can take from Jesse Livermore's story. The problem isn't always knowledge. Imagine a trader who has studied risk management for years. They know that risking 10% of an account on one trade is dangerous. They understand drawdown. They understand position sizing. They understand stop losses. They've watched countless videos explaining discipline. Then one day, They see what they believe is a perfect setup. They normally risk 1%. But this time they think, this opportunity is different. So they risk 5%, maybe 10%. The trader didn't suddenly forget risk management. They knew the rule. They simply believed this situation was special enough to break it. That's the psychological trap. Just this one time. Many trading disasters begin with four simple words: just this one time. Just this one bigger position. Just this one revenge trade. Just this one time moving the stop. Just this one time entering without confirmation. Just this one time holding through the news. Just this one time ignoring the trading plan. But one exception makes the next exception easier. Eventually, the rule isn't a rule anymore, it's merely a suggestion. Livermore understood the market, but he was still human. Livermore developed an extraordinary understanding of speculation. He understood price movements. He studied market behavior. He understood the importance of timing. He knew that losses were part of the game. But understanding these principles didn't make him immune to human weakness. That's an important distinction. A trader can understand the market intellectually, while still struggling emotionally. And that's why simply learning more strategies doesn't automatically make someone a better trader. Sometimes the trader doesn't need another strategy. They need better self-control. The battle between the plan and the emotion. Imagine your trading plan says, risk 1%. But your emotions say, this trade is special. Your plan says, take the loss. Your emotions say, give it more room. Your plan says, stop trading after your daily limit. Your emotions say, one more trade and I'll recover. This is where the real battle takes place, not on the chart, inside your head. Why traders move their stop loss. Let's say you enter a trade. Your stop loss is 20 pips away. The market moves against you. You're getting uncomfortable. Then the price gets close to your stop. You think, it's probably just a temporary pullback. So you move your stop another 20 pips. Now the market moves closer again. You move it again. Eventually, your original risk of 1% becomes 3% or 4%. Why did this happen? Because you didn't want to accept the information the market was giving you. The original trade idea was invalidating. But emotionally, you weren't ready to admit it. The pain of being wrong. This is one of the deepest psychological problems in trading. Humans don't like being wrong, especially when money is involved. You enter a trade because you believe something will happen. When the market proves you wrong, your brain naturally wants to defend your original belief. You start looking for evidence that supports you. You ignore evidence against you. This is how a trader can become trapped inside a losing position. They're no longer analyzing the market objectively. They're trying to prove themselves right. Livermore's lesson: the market doesn't care about your opinion. The market doesn't know your entry price. It doesn't know your prediction. It doesn't know how much money you've invested. And it certainly doesn't care whether you feel embarrassed about being wrong. Price simply moves. Your job isn't to force price to agree with you. Your job is to respond when your original idea is no longer valid. That requires humility. The most expensive emotion. Many people think greed is the most dangerous emotion in trading. Sometimes it is, but another emotion can be even more destructive: the need to be right. Greed says, I want more money. The need to be right says, I refuse to accept that I'm wrong. That second emotion can keep you inside a losing trade long after your analysis has failed. And the longer you stay, the more expensive the lesson becomes. Professionals don't try to avoid every loss. A professional trader doesn't build a system designed to eliminate losses. That's impossible. Instead, they build a system where losses are controlled. They accept, this trade didn't work. Then they move on. No revenge. No excuses. No emotional debate. Just, next opportunity. That's a completely different relationship with losing. The power of pre-decision. Here's a practical lesson you can take from this. Don't decide what to do while you're emotional. Decide before entering. Before taking the trade, define entry, stop loss, target, risk percentage, maximum daily loss, conditions that invalidate the setup, then execute. Why? Because it's much easier to make rational decisions when your money isn't currently moving. Once you're watching your account rise and fall, your emotions become louder. Write this down. Before every trade, ask yourself, what would make me admit this trade is wrong? If you can't answer that question, you probably aren't ready to enter. Because every trade needs an invalidation point. And here's another question. If this trade loses, will I still follow my plan? If the answer is no, your position may be too large. Reduce the risk until you can think clearly. The real measure of discipline. Discipline isn't proven when everything goes your way. Anyone can follow a plan when they're winning. Discipline is proven when you're down money, you're frustrated. You're watching a trade move against you, you want revenge. You desperately want to recover. And you still follow your rules. That's discipline. Jesse Livermore's story reminds us that the market doesn't only test your intelligence. It tests your character. It tests your patience. It tests your ability to admit you're wrong. It tests whether you can follow your own rules when breaking them feels emotionally easier. And that's why becoming a better trader isn't simply about learning more. Sometimes it's about doing less, fewer trades, smaller risk. Less emotion, less prediction, less ego, more patience. More preparation, more consistency. The ultimate goal isn't to become a trader who never breaks a rule because they never feel tempted. The goal is to become a trader who feels the temptation and still follows the plan. Because that's when knowledge becomes skill.